once we start to see rate cuts, we're going to start to see a lot of buyers come off the sidelines. In September, the Fed cuts rates 50 basis points. I think we're going to see asset prices spike. And I think that's a secondary question. The first question is what's going to happen with the economy? Because that's going to influence what happens to real estate in almost all cases. Conventional wisdom is that right now there's somewhere between 200 billion and 300 billion sitting on the sidelines allocated for real estate or prepared to be allocated to real estate.
Brought up politics, not me, but Ken asked, is the election in November a factor?
I don't believe it is.
Transaction volume, man, it's still, I think it's starting to pick up, but it's still pretty low, right?
It is. It is. I think there are a lot of sellers out there who they saw what their properties were worth or assumed what their properties were worth back in 2021, 2022, got really excited about it. And then kind of the interest rates started to go up and sellers realized that the value of their properties were going down because cap rates were going up. But I don't think they want to let go of what in their mind was the value of their property a couple of years ago. And I say that with some personal experience. I mean, we're in a situation where we had a property under contract to sell back in March of 2022. So just before interest rates started to go up, interest rates started to rise, buyer backed out. And we are very much, I hate to say it, but anchored to that sale price. Like we feel like we don't want to sell for less than that price, even though we know today that property is worth less than it was worth 2 years ago. And so luckily we're in a position where we can hold that property without any issue, but we just have this anchor in our head that this property is worth this amount because that's what it was worth 2 years ago. And we don't want to sell it. And so I think there are a lot of sellers out there who feel the same way. They're not looking to take a discount on what the property was worth a couple of years ago, even though realistically it's just not worth that anymore. And buyers on the other side of the equation are saying, I need a discount. The market's crap. The interest rates are up. I'm not willing to pay what I paid 2 years ago or was willing to pay 2 years ago. I need a discount. I need a great deal or I'm going to sit on the sidelines. And so with both sides basically basically refusing to compromise, what we've seen is no transaction volume for the last 2 years.
But when's that going to get fixed, Jay? I mean, that's been going on for a while. It's been at least a year now that we talked about, we're trying to discover what true cap rates are because of everything that happened basically starting 2 years ago. How long is this going to go on where people realize, okay, this is the new price. This is no longer 2021 prices, 2022 prices. Like, are you seeing that unwind a little bit or is that still going on?
So conventional wisdom is that right now there's somewhere between 200 billion and 300 billion sitting on the sidelines allocated for real estate or prepared to be allocated to real estate. That's a lot of money. I mean, $250 billion buys a lot of property. And so I suspect that when investors start to recognize that we've hit bottom and that they can put that money to better work than they can by buying treasuries or in the stock market or whatever else they're buying these days, when they can see that in the next 3 to 5 years, they're actually going to make money in real estate, they're going to start moving money off the sidelines. So what's that going to take? I suspect as interest rates start to come down and as treasuries start to come down, and I suspect as the stock market probably flattens out because we have seen some tremendous growth in the market, maybe it'll keep going. But I mean, statistically, the equities market to continue to grow at the rate it has been is unlikely. I think as people realize that real estate is back, and there's an opportunity over the next 3, 5, 7 years, and they think back to the fact that real estate has the best risk-adjusted returns of any asset class out there, I think things will start to get back on track. So I think it'll take a rate cut or two. I think it'll take the stock market kind of staying flat for a little while, but I suspect in the next 6 to 12 months, we're going to see that.
Well, I was going to tell everyone that this is like one of my easiest podcasts or lives to do because I just basically take the same exact questions from last time and I asked Jay the exact same questions and, hopefully the answers are different because it's 6 months later. So, but I'm going to start with like maybe a more open-ended one than usual, which is, definitely bring us up to speed of where we are today in the economy. Because I get the sense from the data, the chatter that I feel like we might be at a point where we're starting to turn, where maybe rates might be over being hiked and turning and it just things. I feel like we're at a turning point. So bring us up to speed and let me know if you agree with that sentiment that I have. Like, it sounds like something's about to move in a different direction.
I do agree with that. Although I remember 6 months ago, I agreed with that also. I mean, it's felt like we've been there for a while. Jerome Powell, the head of the Fed, came out back in December and said, "Hey, we're going to start cutting rates in 2024. Expect something like 6 rate cuts." And then by the spring, it was, well, okay, we're still going to cut in 2024, but now it's going to be 3 rate cuts. And then by June, July, it was, yeah, well, maybe we'll get a rate cut if we're lucky in 2024. So it was the trajectory was kind of, hey, it looked like we were going to get some rate cuts. It looked like we were going to get some movement in the market. It looked like things were going to change. And then by summer, beginning of the summer, suddenly, I mean, the market was hot, employment was hot, GDP was hot, everything was going great. The Fed kind of reversed course on all these rate cuts. And so come June, July, it started to seem like, okay, it could be another 6 or 12 months before we see any movement. Well, just last week, if anybody was paying attention, Fed came out with some less than stellar news on employment. We saw a spike up in employment. We saw fewer job gains than was expected. Some other stuff internationally that kind of spooked the market. And suddenly, stock market dropped for a couple days. Treasury yields dropped for a couple days. People were buying gold. People were selling crypto. Everybody got terrified. We started seeing social media flooded with, here comes the big crash. And we're not seeing that big crash, but certainly people are getting it through their heads that this could be the turning point, as you said. And the Fed is now talking about, next meeting is in September. We'll likely see, or almost certainly see, a rate cut as of now. Could be more than a quarter point, could be a half point. Some people are talking about 3/4 of a point rate cut, which would be a huge cut. So yeah, I don't know if the economy is really on the brink of changing or not. That remains to be seen. We have to see what the next set of data looks like. But certainly the Fed is on the brink of taking action, which, if they cut rates, that could have a big impact on all asset classes.
Yeah, let's talk about that, because I think there's the prevailing view that when the Fed starts cutting rates, that becomes like the save all, like everything now becomes, especially specifically in the real estate world, so multifamily, which has struggled a lot with the rate hikes. Single family, buyers aren't there because all the sellers are locked into their 3% mortgages and don't want to sell. Like, what is going to be the effect? Do you think that if the Fed does start cutting, even if it's like a quarter a point or 50 basis points, is that going to make a huge impact on the real estate market? And if so, why or why not?
Okay, well, let's start with, I think of real estate as the trailing indicator. Real estate kind of doesn't act or react except based on what else is going on in the economy. 2008 was an exception. 2008 was the one time in like the last 150 years where, because real estate was in the crapper, because real estate was tanking, and we had all these issues with mortgage-backed securities and all these other things, that it kind of crashed the whole economy. But other than 2008, every other recession, every other economic cycle we've seen in this country, it's been the other way around. The economy does stuff, and that impacts real estate. So the question isn't, what do we think is going to happen with real estate as the first question? I think that's a secondary question. The first question is, what's going to happen with the economy? Because that's going to influence what happens to real estate in almost all cases. So asking the question that way, if the Fed cuts rates, what happens in the economy? Fed cutting rates has essentially 2 effects. One, it has the sentiment effect, which is, how are people going to act differently now that they see the Fed's cutting rates? And I expect that think back to last December, the Fed just talked about cutting rates 6 months in the future, and the market went crazy. I mean, it set expectations that, okay, we're going to see another big boom. Asset prices are going to go through the roof. We're going to see lots of opportunity to buy stuff, and things went crazy. So there's the sentiment piece. And I think what we're already seeing since the bad news last week is that, with renewed talk about a Fed cut in September, people are already starting to spend money, and asset prices are already starting to recover. And so I think once the Fed actually does cut, we're going to see a lot of exuberance, whether it's irrational exuberance or rational exuberance, I don't know, but we're going to see a lot of exuberance, people really happy, excited, spending money, feeling like, okay, things are on track again. Secondarily, there's the more tactical piece of this, which is when the Fed cuts rates. What happens when the Fed cuts rates? Typically, we see bond yields drop. And so all this money, all these trillions, tens of trillions of dollars that are sitting in bonds, those investors need to decide, Do I want to keep money in bonds at a lower yield, a lower return? Or do I want to go look for a better return somewhere else? Do I want to move this money from bonds into real estate or into gold or into the stock market or into crypto or something else? And the more the Fed cuts rates, the more incentive there is for people to move that money somewhere else. Even if you have money sitting in a savings account, maybe you're getting 4% on a CD right now or 2% on a savings account. When the Fed starts cutting rates, CD yields are going to go down. Savings account yields are going to go down. People are going to want to move their money someplace where they're going to get a better return. And so people, in addition to being excited and exuberant about the rate cut, reality is going to set in, and they're going to say, in order to maintain a good return, I need to move my money somewhere else. And when they do that, if they move it into the stock market goes up. If they move it into real estate values go up. If they move it into crypto goes up. And I suspect that when the Fed cuts rates, assuming everything else in the economy is pretty stable, and we can talk about that assumption, but assuming everything else in the economy is pretty stable, if in September the Fed cuts rates 50 basis points, I think we're going to see asset prices spike.
Let's talk about that assumption.
Including real estate.
Yeah, let's talk about that assumption. And by the way, if you guys have a question specifically for Jay, just drop in the chat so we can make sure we're addressing your specific question. But let's talk about that assumption, because I've always thought that the central bank starts cutting rates when things aren't going well. That's the whole point of having a Fed. They control the money supply. When things are tight, things aren't going well, they ease money and they just let more money in. When things are going well, they're worried about inflation, they tighten. If interest rates go down, do you think that's a good assumption that the economy will remain the same, or is the reason they're cutting is because the economy is not doing well? So it's like, I feel like everybody assumes the interest rates are going to cut and things is going to be great. When in my mind, it's always been the opposite. What do you say about that?
So historically, the way the cycle works is we have a booming economy. And when you have a booming economy, what happens? Businesses have to deal with all this excess demand. Restaurants are getting a lot of customers and product companies are selling lots of products. So what do? They have to hire more people, and they have to build more warehouse space, and they have to buy more inventory, and all this stuff costs money. And so what they do is they pass on those cost increases to consumers, which causes inflation. So you get a really hot economy, causes inflation. The Fed wants to stop inflation, so they raise rates. Raising rates, for reasons that we've talked about in the past, generally causes a recession. The Fed waits too long to cut rates. They're in a recession. They want to spur the economy again, and they cut rates. So that's the typical path. Well, we sort of saw that. So we saw the booming economy. We saw the raising rates back in 2022. We've seen inflation come down. Normally, inflation coming down is associated with that recession. We didn't see that recession. But normally we'd be in a recession right now, or we'd be heading towards a recession, and the Fed would be saying we have to cut rates because we're in a recession, we have to get out of it. In this case, for some reason, and again, we can talk about that, for some reason, we're not seeing the recession. We're seeing inflation come down. We're seeing high rates. Normally, Fed increased rates 5 percentage points. Highest spike in the shortest amount of time in history. Economic theory says that should have caused a recession, but it didn't. But now we see inflation coming down, and the Fed is concerned not because of a recession right now. We're not in a recession technically, but the Fed is concerned that if inflation comes down too quickly, that we could find ourselves in the midst of a really bad recession because they waited too long. So basically last December, Chairman Powell came out and said, we're willing to start cutting rates even before we see a recession if we see inflation coming down to that target number. And I suspect he didn't say this, but I suspect what it was in his head was, we're terrified of it flying through that target number, dropping below zero, so we actually see deflation, which sounds like a great thing, prices going down, but for lots of reasons, we don't like to see deflation. And so the Fed has to get ahead of this dropping inflation by cutting rates, even though we haven't seen a recession.
And it's really weird because there's something, as you know, Jay, called the wealth effect, right? Where people, if the stock market's going up, if the real estate portfolio is going up, people feel wealthier, they tend to spend more, and it's all psychological. And if the reverse happens, the same thing happens. If your stock portfolio, even if it's your 401k, which technically you don't even control till you're later, you tend to react to that by cutting back in your spending. And that's one of the things the Fed wanted to do with increasing the interest rate was to get the stock market to come down, to get real estate prices down. And that hasn't happened. We always talk about the process of like, where is the stock market right now? S&P, when they started raising these rates, was at 4,300. It's just steadily been going up. Every time we meet, we measure this, and it was 4,500, 4,800. I think today it's around 5,400. So the stock market continues to go out. Real estate prices, when you look at the single family home market, that still hasn't come down. Those prices overall nationally are the same, and yet inflation's coming down, that's kind of the conundrum that's kind of weird. It's almost like they failed with their economic policies of trying to get these asset prices down, and yet inflation has come back down. Not quite at the 2% target, but it's getting close. Any insights, Jay, as to was it just a temporary inflation? Was it transitory after all? Is that really what was going on?
So I mean, I hate to use the word transitory, because what's transitory? A month, a year, 3 years? I mean, if you define it broadly enough, sure, it was transitory. It only lasted about a year, but a year did a lot of damage. I think part of the dynamic that's different this time around is that people are a little bit smarter. I think social media, the internet, all of the podcasts that are out there and other stuff that are out there, us doing things like this, has increased the intelligence of the average American. And I think up until a few years ago, maybe a decade ago, the Fed led the people. So people would sit back and they'd say, oh, rates were cut. What am I supposed to do now? And they would take action. Oh, rates went up. Okay, how's that going to affect my savings account or my credit card rates or being able to buy a car? Okay, that's how I'm going to react to that. And so the Fed would take action and people would react to it. These days, people are very attuned to what's going on in the economy, very attuned to asset prices, to the Fed movements and how things work. And so for the first time in my history, at least, I hear people predicting, regular people predicting what the Fed's going to do and how that's going to impact the economy. Never in my life have I heard people talking about, yeah, I'm expecting a rate cut, a half-point rate cut in September. Like, people just didn't talk about that 2 decades ago. Like, yeah, we knew that there were cycles. We knew that there were recessions. We knew that the Fed cuts and raises rates, but we never really anticipated it or planned for it or tried to predict what we should be doing with our investments based on it. Obviously, big investors did that, but the little guys just never did that. And I think that's one of the things that's different this time around. And again, we saw this in December. Just Powell, the Fed, saying, hey, we're going to cut rates in 2024, didn't actually have to cut rates, didn't even have to be telling the truth. Turns out that they haven't done it yet. Just talking about it, that was enough to get people to completely change their patterns and their habits for spending. And that impacted the economy tremendously. And so I think the Fed is probably kind of figuring out or trying to figure out how to navigate this new world where people are trying to predict what they're doing. And just like these prediction mechanisms, people looking and seeing prediction markets on what's going to happen with interest rates, that's impacting the economy, which I think takes power away from the Fed. They have to be a lot more careful about what they say and what they do. They have to kind of couch things in a lot more subtle terms, because otherwise people are going to kind of get ahead of what the Fed's doing. They're going to start acting as if there's a rate cut because they believe there's a rate cut coming. And now the Fed is behind the curve.
Let's talk specifically about switching over to the multifamily space. I know obviously real estate is not just multifamily, but that's obviously what you focus on and know most about. We talked about last time well, let me ask you a general question, which is, how is multifamily doing as a whole these days? Because last time you talked about how really multifamily kind of quote unquote crashed the first couple months, the first couple quarters when rate hikes started coming up. But ever since then, it kind of like stabilized over the last probably now 18 months. Can you bring us up to speed of what you're seeing out there in the multifamily world regarding, especially about price action and buyers and sellers? What is that looking like these days?
So as usual, it's always a little bit more complicated than it seems. And yeah, I've talked about the fact that in March, April, May of 2022, we started to see interest rate hikes. As soon as we saw interest rate hikes, multifamily kind of shut down. Transaction volume slowed, cap rates started to go up, values started to drop. And over 3-6 months after interest rates started to increase, multifamily values dropped 20 to 25%. Since then, in the last 18 months or so, we've seen another 5 to 10% drop. So we're probably somewhere in the 25 to 35% range across the board for multifamily. Now, the question is that are multifamily values where they're supposed to be? That's a hard question to answer because we bottomed out on multifamily, and we've now started to see values start to increase over the last couple months. Is that temporary, or is that going to be a consistent trend from here? I don't know. But here's the big thing you have to remember when it comes to, and this is the same in single family, multifamily, any other commercial real estate, is that it can be really difficult to know what true prices are or should be when there's very little transaction volume. We don't have this thing called price discovery. If my neighbor, if nobody in my neighborhood, if nobody within 2 miles of me sells a house for 2 years, I don't know what my house is worth because my house is worth based on the comps, based on things that are selling around me. If nothing's selling around me, I don't know if the value of my house has gone up or down if I tried to list it. And it's the same thing in commercial real estate. In commercial real estate, we have these things called cap rates, which is just a multiplier that determines how much your property is worth. We don't know what cap rates are for most commercial real estate asset classes right now because there's so little transaction volume. There's very little price discovery. So we don't know, for those that are familiar with the parlance, we don't know if cap rates in a particular market are 5.5% or 6% or 6.25%. And just the difference between like 5.5% and 6% cap rates in a market can make the difference of millions of dollars in value on a particular property. And so because we don't have a lot of transaction volume right now, we don't have a lot of price discovery, it's hard to tell if multifamily has kind of stabilized and is going to go up from here, or maybe if we start to see a lot more transactions and we get more price discovery, we could see that we have a much longer way down, or maybe we have a quick rise up. We don't know. That's the whole point.
What's it going to take to get that transaction volume up?
I think rate cuts will handle a good bit of it. Once we start to see rate cuts, we're going to start to see a lot of buyers come off the sidelines. They're going to be able to spend a little bit more because suddenly their interest rates on their loans are less. So they have more money left over every month. And so they can spend a little bit more to buy these properties. But the other big thing, and we've been saying this for 2 years now, and it continues to be true, is just time. Every day that passes, every month that passes, property owners who have floating rate loans, who have these things called rate caps, which are insurance products against these floating rate loans, every day, every month that passes, they're getting closer to the end of that loan period or the end of that rate cap period. And they need to figure out what to do when their loan terminates or their rate cap expires. And right now, if rates don't come down, they're probably going to have to refinance and bring money to the table because they're not going to be able to refinance. The properties aren't worth what they were before. And so again, every day, every month that we march forward, more sellers are coming closer to that cliff. And as sellers get closer to that cliff, there's more incentive to sell. And so I don't know what the trend line looks like because some sellers are very creative. They figure out how to extend those loans. Some banks are being favorable to sellers and letting borrowers extend those loans. But regardless, every day that marches forward, we're getting closer and closer to that cliff for a lot of sellers. And so I suspect that as time goes on over the next 3, 6, 12 months, we're going to see more transactions simply because more borrowers, more sellers are in a situation where if they don't sell, they're kind of running out of other options.
Yeah, I'm glad you brought that up because that was going to be actually my next question. That, unlike single family homes where, interest rates could go from 0 to 100. If you're locked into a 30-year mortgage and you don't have to sell, it doesn't really affect you at all. But in multifamily and really most commercial real estate, you don't get a 30-year mortgage. You get a 7-year loan, maybe a 5-year, maybe a 10 at most. But at some point, those rates will affect you. And that was going to be my question. We always talk about this keyword lag, because there is a lag between the time the interest rates go up and where it really does affect a multifamily or a commercial lender. And that was one of my questions, like, where do you think we are in that cycle in terms of, how many of these guys or gals have already been kind of flushed out and had to make their move, and how much is still left over? I think last time you mentioned that you thought that number was less and less and less. I don't know if we have specific numbers or nothing, but I think the peak was supposed to be 2023, 2024 of where most of those interest rates were going to be ending.
Yeah, 2024 was the peak. I don't recall offhand what the exact curve number looks like or the exact numbers
Yeah.
are, but yeah, this year is the peak. And just to kind of put some context around that, uh, in the multifamily space, if you're going to get a floating rate loan, it's probably going to be somewhere between a 2 and a 5 year loan, with the sweet spot somewhere in the 3 to 4 years. Which means somebody that got a loan in 2020 is coming due in 2023, 2024. Somebody that got a loan in 2021 is coming due in 24 or 25. 2022 is where we saw interest rates start to go up, and so nobody was getting these loans after March of 2022. So the question is, where is the kind of the ending, and the end demarcation is kind of 2021, or let's call it the beginning of 2022, plus 3 to 5 years. That's kind of that's the point at which all of these loans in theory should now be terminated, and we're kind of on the other side. So what does that put us at? That puts us at beginning of 2025 to beginning of 2027. And so the ones that were originated in 2020 are probably already coming due 2021. Some of them are coming due, but I think 2024, 2025 is probably where we're going to see the peak of that curve. And then after like spring or summer of next year, we're going to be getting towards the end, and it'll just be those properties that were purchased like late in the cycle, 2021, beginning of 2022.
Yeah, and I would say definitely heavily weighted towards that 3 year, because these loans,
Yeah.
because we dealt with so many of them, they were literally they were 5 year loans, but they were really 3+1+1. So they're really
Yep.
3 year bridge loans, and they had 2 1 year extensions. I think one of the biggest mistakes a lot of syndicators made was just assuming, oh, I have another 1 year extension, almost like an automatic extension, which is people are finding out is far from true. But that first 3 year, but you did mention rate caps. I wanted to talk about that because rate caps was such a huge story, a year ago or something. And now that interest rates appear to have peaked and maybe going to start coming down the other way, remind everybody exactly what a rate cap is, but then also, is that softened a little bit? Is it easier now to get that insurance because people aren't really expecting interest rates to be at 9% by the end of next year? They're thinking, if anything, it's going to be lower.
Yeah, so a rate cap is an insurance product. So if I get a floating rate loan, which is a loan where the bank says every month you're going to pay me based on an interest rate that's based on some other interest rate that the government sets or defines. So if interest rates go up next year, your loan interest rate is going to go up. If interest rates go down, your loan interest rate is going to go down. And the bank wants to know that if interest rates go up too much, your loan interest rate is going to go up too much and you're not going to be able to pay your loan. So they make you buy this insurance product where basically the bank says, okay, if interest rates go up more than 3%, now insurance is going to cover the difference. And so if you ever get a floating rate loan in the multifamily space, the lender is probably going to make you get this insurance product just to avoid rates going so high that you can't pay. Just to give an example, and I've used this example before, we bought a property in 2020. We got this insurance product. It cost us $30,000 a year to get insurance against our floating rate loan. Last September, we had to renew that insurance policy because it was a 3-year policy. So started in September 2020, ended in September 2023. When we had to renew, the insurance price went from $30,000 a year to over $500,000 a year. We just had to, we renewed for 1 year, which means this September, next month, we need to renew again. We just locked in a new price. We're in the 300,000s. I don't remember exactly, like somewhere between 330 and 360. So good bit higher than the original 30,
Yeah.
good bit lower than the 540 or something that we had last year. So
What's the question? Did they tell you, did the broker tell you why? Because to me, that sounds like it's still a 10x over what you originally paid.
Yep.
And I don't know anybody, I would almost argue that the odds of the interest rate being lower 6 months from now is much higher than it was back in 2020 to say, I mean, it was almost mathematically impossible for it to be lower. So why is it still 10x from what it was in 2021?
So the big thing that drives rate cap prices is volatility. And so conceptually, all of us can sit on this call and say there is zero chance interest rates are going to be a point or 2 points or 3 points higher a year from now than they are now. But the reality is that there's a lot of volatility in the market. And there are a lot of people who back in 2021 thought there's zero chance the Fed's going to be raising rates. And so the market recognizes with all this volatility that crazy things can happen. And part of insurance and the underwriting that insurance does is they have to take into account these black swan events. They have to take into account these crazy things happening, and volatility increases the chance of a crazy thing happening in either direction. And so we're still seeing a relatively volatile market. And because of that, rate cap prices are still pretty high. Now, keep in mind, 6 months ago, there was a lot less volatility. We locked in our price last week when there was a little bit more volatility because of all the things that were going on last week, as we recall. 6 months ago, there was less volatility, and we probably saw rate cap prices a little bit less than we're seeing today. So the trend is definitely down, but we're nowhere near the prices for these insurance products that we were 3 years ago, 4 years ago.
And are you locking those in now just for 12 months, just because of that? Or is that I mean, not that you're recommending anybody, but like, if you were to make a recommendation, would you say, don't do it, don't get a 3-year lock, get a 1 year or whatever the least amount you can?
So there's some complicated game theory and math that goes into it. That said, these prices are pretty efficient, meaning that you're not paying a high premium over like where interest rates currently are. So if interest rates were to go up higher than the amount that triggered the insurance product, the insurance to pay out, the cost of the product is based on what you could realistically expect. It's long story short, there's a bunch of math involved. My partner has spent a lot of time, Kyle, has spent a ton of time kind of figuring out the game theory behind it. And it turns out that at the end of the day, the insurance companies aren't making a ton of money. There's no right or wrong answer, but yes, we are focused on 1-year policies because we do believe that rates are going to go down next year. But we're guessing as much as anybody else.
Yeah. One of the pains for syndicators was before, and I want to ask you about this, is are banks still requiring you to escrow those future rate caps? I know that was an issue before where you say, oh, great, you got to renew your insurance in a year and it's going to cost you this. But the banks were like, I don't necessarily believe you. You got to escrow that amount monthly here. And that really does strap you on the cash flow. Is that still going on, or is that eased up a little bit?
Yeah, and that's actually been one of the big issues. And I can't speak to the specifics because, again, this is Ashley's side of the business. But as far as I know, the answer is yes. They're still requiring that, which means last year we bought a new rate cap at, I think it was like 540,000 or something. And the bank said, okay, it's a 1-year insurance policy, so you need to start escrowing for the next one a year in advance, which is today. You buy the policy today, it's a 1-year policy. You need to start escrowing for next year, a year in advance. So the day we bought the policy, we also had to start escrowing for this year. They determined that the amount we had to escrow was based on last year's price. So we've been escrowing basically $540,000 a year for the last year, even though we knew for a fact that prices were going to be lower this year. And they were 300 and some thousand. So we'll get a rebate now that we've bought the new one, but that didn't help us or our investors for the previous year where all that money was sitting in the bank's escrow account.
But is that good news for investors now? Because it generates, it's not really new cash, but it's cash that becomes accessible and your cash position strengthens.
Absolutely. For anybody that bought a new rate cap in the last year or two when rates were exorbitantly high and now have to, and are still holding the property and now have to move into a new rate cap, they probably will be getting a discount. So it definitely, for some people, that'll be a nice little bonus.
Cool. Guys, remember, if you guys have a specific question for Jay, please drop it in the chat. Jay, what's the biggest risk in real estate right now?
I'm going to go back to what I said earlier, which is real estate itself isn't the risk. It's all the things that impact real estate. So it's the economy that's the risk. And I'd say the biggest risk to the economy right now is jobs. It's the one part of the economy that we're starting to see some cracks. I mean, it's not the only one. And depending on how you want to slice it, you could say that inflation is still an issue because even though we're not seeing prices go up a lot every month anymore, we saw them go up 20, 30, 35% over the last couple of years. So that still hurts us. There's a huge wealth gap, which I don't want to discount. A lot of people suffering, a lot of people pushed down from the middle class. But at a macro level, I think the biggest risk to the economy is jobs. And if we see a lot of jobs go away all at once, or if we find that there's some major shift in the jobs market, let's say from AI, which I don't expect to be in the next 6 or 12 months, but certainly over the next few years, as people start losing their jobs, that impacts all other areas of the market. When people lose their jobs, they stop buying stuff. They stop paying their mortgage. They stop paying their car loan. They don't have any money to save, so they're taking money out of the bank, and basically everything starts to break. And so the thing that I'm watching most closely right now is the jobs numbers, and I think that's the thing that would have the biggest domino effect on the economy, which would ultimately have the biggest domino effect on real estate.
True or false? The second biggest risk is Jay Powell.
So, I mean, we can talk about Jay Powell and whether he's good or whether he's bad. And at the end of the day, I don't know if Jay Powell is a genius or an idiot. I do know that he's got a really, really hard job and he's getting pressure from all sides. And I think we have the benefit of hindsight. We see the decisions Jay Powell made a couple of years ago. If they were bad decisions, we say he was an idiot. He shouldn't have done that. If they were good decisions, he did a great job, whatever. I think if we were to ask anybody on this call, including me, including you, what to do a couple of years ago, the likelihood of us being as successful as he was hopefully, well, hopefully he had a better chance. But I'm not going to disparage Jay Powell for the decisions he's made. I would have made some different decisions, but again, I have the benefit of hindsight. I think he waited too long raising rates. But at the same time, I mean, some really, really smart people thought that inflation wasn't going to be as bad as it was. And I know everybody's saying, well, how could inflation not be horrible? We printed $9 trillion in 2020. We printed $8 trillion since then. How could we not have high inflation? Well, we printed $8 trillion back after the Great Recession in 2008. We saw the lowest inflationary period in history, or in modern history, between 2010 and 2015. I mean, if you look back to the Obama years, and I'm not giving Obama credit or taking credit away from him. He wasn't a factor. But we saw lower inflation during Obama leading up to Trump than at any time in modern history. We saw low inflation during Trump, but we printed $8 trillion between 2008 and 2011. Why didn't that trigger inflation? It boils down to all of this is more complicated than we like to make it out. We like to say simple things like you print a lot of money, you get inflation. It's not always the case. And Powell is smart enough to know it's not always the case. And he didn't want to, I assume he didn't want to raise rates prematurely. He waited too long, but when he made that decision at the time, I'm not sure it was the wrong decision.
Yeah, you brought up politics, not me, but Ken asked, is the election in November a factor?
I don't believe it is. Here's the way I look at it. If half the people want to say that Powell is trying to help the Democrats, other half say Powell is trying to help the Republicans. If Powell wanted to help the Democrats, he would have cut in July. There was plenty of cover to cut in July. Lots of people, myself, not that I mean anything, but lots of smart people like economists were out there saying, you got to cut. We're starting to see inflation drop too quickly. He could have cut in July. Nobody would have batted an eye, especially when 2 days later that the bad employment numbers came out. He would have looked like a genius. So if he wanted to help the Democrats, he could have cut in July. He didn't. If he wanted to help the Republicans, he wouldn't cut in September. But I think it's almost certain that he's going to cut in September. So I mean, do I know what he's thinking? I don't. I mean, he was appointed by Trump. So I mean, Republicans liked him at one point. Biden didn't try and get rid of him. So Democrats liked him at one point. But I think he has a chance or had a chance to benefit either party. He didn't take the opportunity with the Democrats. I don't think he's going to take the opportunity with the Republicans. So my take is he's not being political. The Fed's not being political, but I know people disagree with that.
I want to ask you in a second here, what folks you think folks should be doing if the market does end up crashing and a disaster. But I want to get Brent was asking about the software stuff you guys use at Bar Down. What software models do you guys use to analyze investments, CRE investments?
We have our own proprietary underwriting model. that we use. So we actually hired a really good developer who spent about 6 months creating a new model for us, because we've been using a lot of the same models that everybody else in the industry uses, and there are a lot of good ones out there. But we just wanted something a little bit more focused on how we do our underwriting. So we created that, and happy to give a little bit more information if you want to reach out to me, but it's our proprietary model.
Yep. And two quick plugs. One is Jay and I did an episode about the same time the last one came out about how to underwrite like a pro. So we talked a lot about underwriting. And then Jay, you came out with it. Was it a course or something you did, like basically an underwriting course that you and Ashley were doing?
Yeah, so in July we did a 4-week course, an hour and a half every week. So it was a 6-hour course that we did on underwriting using the model that we developed. So if anybody wants more information about that, reach out to me. We don't sell a lot of things, but that was one of the few things that we sold was that 4-week underwriting course. Happy to give people more information.
And what is it, like askj.com? What is it? What's your cool URL?
jscott.com.
Oh, jscott.com. All right. Really, really brilliantly orchestrated. Okay. I think you may have talked about this in the upcoming Bigger Pockets podcast, but since I got you, actually, this won't come out probably until afterwards, but everybody who's here live get a preview of your Bigger Pockets podcast. So I think the question there was like, what do you do if the market does crash? Right? I think that was one of the topics. So as real estate investors, if the economy tanks for whatever reason, I mean, we saw a little bit of that last week. We were a little bit worried on Monday when, stock market was down 1,000 points. I mean, that could have easily become unraveling really quickly, and we could have had an emergency cut by the Fed. It could have been like all hell breaking loose. If that were to happen, just generally, you don't need to spend, 3 hours on it. In fact, I'm going to ask you not to spend 3 hours on it. What should people do? What should investors do if something like that were to happen?
That's Mauricio's way of reminding me how long-winded I am. So what I would say, let me start with, if we see a major crash in the markets, whether it be real estate or the stock market or any other market, everybody likes to imagine like, okay, the value of real estate is going to drop, but everything else in the world is going to stay the same. The reality is when there's a crash in anything, it affects everything. And we don't get the benefit of lower real estate values without all the bad shit that comes with it. Excuse my language. So for example, if we saw a big crash, we'd probably see lending tighten ridiculously, very quickly. We would probably see the ability to get loans kind of, I don't want to say go away, but if you remember back in 2008, it was really difficult to get loans. It would probably be very difficult to get access to investors. So if you're looking to syndicate, when there's a lot of fear in the market, a lot of the investors kind of hunker down and they wait and see. They don't want to spend a lot of money. So raising capital is going to be really difficult. So if we saw a big downturn, I think the most important thing, and this is something that you should be preparing for now, is relationships. Have relationships with lenders, have relationships with private lenders, have relationships with partners who have access to capital, so you don't necessarily need to go out to passive investors. Have relationships with everybody in the business that can help you when you aren't going to have access to capital. Because when things crash, that's what goes away the fastest. That's what goes away the soonest, is capital. So building relationships now with those who have the capital, again, whether it's private lenders, agency lenders, partners, et cetera, having those relationships is probably the most important thing, because your cash is going to be king. And if you don't have it yourself, you're going to need access to it from others.
Yeah, for you youngsters out there, it's unbelievable. It's like 16 years ago, but it seemed like yesterday for Jay and I. But you got to remember, interest rates went down to 0, right? But dude, good luck getting a loan back then. I mean, you couldn't get a loan. Even if you had like an 800 FICO score and had a great income, it was, virtually impossible to get a loan. So just because interest rates go down doesn't mean that lending is going to be cool. Probably one of the last questions here for you, Jay, unless more questions pop in. But last time you're on the show, speaking about what would potentially cause something like that to happen, a market crash or something like that, you mentioned that you thought businesses were probably going to be the first to crack. That was kind of what we were talking about also on the show as well. Is that still, you still thinking that's kind of where we're at? And are you still concerned about businesses as these interest rates have been kind of permeating through the business cycle, or is there something else you think is going to be the catalyst? Obviously, where everybody's guessed what's the catalyst going to be, but is that still a focus of yours?
Yeah, and I think we're starting to see it. I mean, the tech sector only makes up about 20% of of businesses and that industry, but the tech sector has been getting crushed, especially startup tech has been getting crushed the last couple of years, simply because just like there's 300 billion of real estate money sitting on the sidelines, there's about 300 billion of venture capital money sitting on the sidelines. So startups that typically are used to getting investments from outside investors are not getting those investments. So a lot of those businesses are starting to slow down. They're laying people off. They're shutting down. Larger businesses that rely on issuing bonds. So Walmart and Target, one or both of them came out within the last couple months and basically said that they're not going to be issuing as many bonds because the bond rates were higher than they've been in a long time. Well, when they stop issuing bonds, they stop raising money. That means they're going to stop growing. And when they stop growing, that means they're going to have to start laying people off. And so I think businesses are typically one of the best leading indicators of what's going on. And when you look at businesses, you look at both bankruptcies, which are through the roof. Over the last 6 months, we've seen corporate bankruptcies spike up by like 60% the first half of this year. You're seeing a lot of startups go out of business because they can't raise capital, and we're already starting to see unemployment spike up for just due to the fact that I assume businesses are struggling. So yeah, I think that's a great leading indicator, and that's the biggest one that I'm watching.
Awesome, my friend. Well, hey, what's the difference between jscott.com and investwithj.com? You got so many of these freaking URLs. Is there a major difference?
jscott.com will link out to everything that I have. Anything, if you want my email, if you want anything that I do, jscott.com. Investwithj.com specifically if you want to invest with them.
If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.